I really think Mike kind of hit it on the head in the early comments when we had the panel start, and Jay didn't really pick a fight with this concept that the market's pricing in a couple of cuts after we peak out at 5 or 5.25, and I think that's the market expected to have a fight with the Fed. I think that's what Jay's been doing in most of these press conferences. He's kind of saying, "You guys are crazy. I don't know what you're talking about. We're gonna keep on keeping on," and invoking Paul Volcker statements. And he just seemed really docile, and he seemed in a good place. He seemed calm. And I think, maybe it was just that he's feeling pretty good about, not having the Larry Summerses and the Muhammad Al-Arians on his back about having messed it up so much. He's got inflation kind of doing what he wants it to do. So I think he's feeling good about that. He didn't want to pick a fight. He just sort of came out very Switzerland-like to me today. I don't know.
But he also sort of blessed the market conditions, which have loosened, and the market rally. He gave a green light to keep on keeping on when it comes to buying stocks and bonds.
I think the market did not expect that. I did not expect that. We've seen Jay really kind of push back on this. We need to be vigilant. We need to be strong. It kind of an acceptance that, and he said it another way, Sarah. He said, in all the survey data we're seeing now, people are starting to feel comfortable that inflation is coming down. The expectations in the surveys, the expectations are something they watch really closely. And I think he's feeling pretty good about that. And that showed his confidence today. And I think that's why he didn't pick a fight with the market. He said, look, maybe they're right. Maybe it's going to come down faster than I think. And then they can have their rate forecast where I want it. He doesn't believe it. He doesn't think he's going to be able to do it. But if he's he kind of blessed that if he's pleasantly surprised, he could come to the market's expectations more quickly. And I really didn't think, I thought it was very early for him to do that. Now, he may have misspoke and been a little docile, and we'll get some pushback on that. At 4,300 in the S&P, he might sound a little nastier like he did before Jackson Hole. But, I was surprised by that. That was really, I think, why.
He's going to speak at the Economic Club of D.C. In the coming weeks. So it'll be interesting to see whether that message changes at all in light of market conditions, or if this market continues to rally. But David, the question is, should he be comfortable with the whole disinflation, which he used that phrase and that word? He said it was gratifying to see we're in the disinflationary phase, even if it's early stages. Like, is that the right approach for him to take? Do you agree that inflation should continue to come down from here?
I think it's a dangerous game. The declaring victory early story is really where all of the people who are nervous about him doing something like the mistake of the 70s, that's where they're all pointing, that he's going to declare victory, then inflation comes down, but then surges back up as the Fed either cuts or goes on a protracted period of stability. So I personally think he's going to be much more vigilant. I think he's happy to have the inflation come down. But when push comes to shove, 3, 6, even 9 months later, I think Jay's going to be pretty slow to give you a real victory lap where he's actually turning rates around or stopping QT. I think it's going to be much harder than the market is projecting on that.
So what do you do here if you're an equity investor? Do you put money to work? Because the mantra has always been, don't fight the Fed, don't fight the Fed, don't fight the Fed. Should you fight the Fed now? Because it sounds like even he's coming around.
I mean, I think it's pretty good for our trade, Sarah, that you and I've talked about a bit, and I've been talking with some of the other hosts about. I think it's pretty good for the high-yield credit markets. You've got a lot of carry. You've got loans and bonds that are yielding 8, 9, 10% in some cases in the junkier areas, single Bs and double Bs. That's a much safer part of the capital structure. If Jay kind of turns on you, you got a big coupon that you're collecting, had a great start to the year in that stuff. And I think for me, it's really hard to tell the 20% up trade in the Dow or the S&P, or even the Russell. I think you've got a Fed that's going to be pretty restrictive for a while and is not going to sound as nice as Jay sounded today. Now, maybe inflation crashes to zero quick and he can go, you know what, look, I got this thing and I can help you out. But I don't see it. And then if that does happen, I think I'm going to make quite a lot of money on my junk bond trade too. I just think it's a safer way to play this year. The bond markets have been beat up. The stock market was not beat up as bad. And I think you can probably have a safer risk reward trade in 2023 in that part of the world.